Okay, good morning again to everybody. I'm going to start off. We have about 32 people online at the moment, and we are discussing treasury management. We started off last week with a brief discussion, or rather, starting the session on treasury management, discussing the role of banking and how banking, the core of banking, which is deposit and lending, and then basically what kind of risk the bank manages, and where treasury sits within that spectrum of the duties done by the bank, what the importance of a treasury is, and basically what the function of a treasury is. Before we go on to today's session, which we will be discussing reserves and basically matters around reserves, can I ask you all for last week? If I ask you all, if I just go back to that. Okay. Just 5 minutes to recap that. Just go on this outline. If I were to ask you, what is a bank's function? What is the core of a bank's function?
Financial intermediation, sir?
Yes. And when you say financial, you're discussing, you're saying what kind of intermediation does it do?
Taking, collecting funds from the excess units and giving to the deficit units.
Right. Yeah. So obviously the role of banks has changed over the years. What we're discussing is the oldest, the most traditional form of banking that has formed when banking was started off, or in one form or the other, which is basically taking deposits and giving out loans to their clients. I mean, right now you have trade, you have investment banking, you have all the other aspects of banking that come into picture now. But this is the building blocks of banking, which is deposits and loans. And in that function of deposits and loans, purely on that basis only, Treasury does a function. But outside of that, there are also other areas the bank works on, like I mentioned, trade and other areas of banking. So if you take all of that, what does Treasury in a bank? What is their primary function? If I were to ask you in 2-3 lines, what does the Treasury do? We've gone into detail a little bit last week, but what does the Treasury do? If you were to answer in 2-3 lines.
Assets and liability management and liquidity management.
Correct. If I were to say Treasury and global markets, and I would say, if you take the whole function, if you were to broaden that aspect of it, what else could the Treasury do?
Risk management.
Risk management in what risks?
The operational risk and no, not operational.
What risk? You're right. Management. Operational risk stems from the function the Treasury does. But if you look at what the Treasury manages in terms of what to do,
it could be market risk management.
Yes, correct.
Liquidity risk.
liquid risk, market risk. There is a reputational risk also that they have to manage. That's there. But when you say market risk, if you take the most common markets and the most traditional market in Sri Lanka, what are the market risks that the Treasury would manage?
Foreign exchange and the interest rate.
Foreign exchange.
Basically, foreign currency risk.
Foreign risk, you said, sorry?
Foreign exchange risk, sir.
Yeah, and interest rate risk also. So
Yes.
basically, yeah, so if I were to ask you, the Treasury does risk management, it manages liquidity, it acts as an intermediary between the banks, deposits and lending functions. So the main reason for doing this is what? What are the main drivers of that function for Treasury?
Safeguarding the interest of the stakeholders.
Yes, very good. What else? Is that the only reason?
Profitability.
That's right. So is it a profit center or a cost center?
It's a profit center, sir.
Right.
Treasury.
So Treasury is not only there to manage the risk of the bank and safeguard the risk of the shareholder in the process of doing that. It is also there to generate an income for the organization. And by doing that, so it's not purely a risk management function. It's not a control function. It's a business. It's a business that has two roles, internal as well as external. So when I say internal, external, what do I mean? Can I say, let me revert that. Can I say Treasury is only an internally focused department or function in a organization?
No.
Okay. Why is that?
If it is a bank, they are managing bank cash position as well as the outside.
I can't hear you, please. If you can speak up a little.
So basically, treasuries that they are dealing with external parties, also with the counterparties, and they also need to manage the nostro and vostro accounts also, and some deals in between that position maintenance and like that. The excess parking for those things, they need to go for an external market also.
Okay. So when I say internally focused, I mean Treasury is managing the balance sheet of the bank through the businesses done from the other sections of the bank and making sure that the bank's risks on those are managed. That's understood. When I say externally focused, I mean that two aspects of that. One means that any function that the Treasury does, it has to worry about the external market. What's happening with the exchange rate? What's happening with the interest rate? What's the economic outlook like? What is the impact of say policy changes, regulatory changes on the economy, etc., etc., etc. So it has to be externally focused in order to manage the internal risk coming from the other sections of the bank. Number one. Number two, it has to be externally focused because it faces clients as well. So, for example, there is a sales desk in the Treasury department, which has to talk to clients, which has to provide clients with risk management solutions, which has to provide clients with the with liquidity in terms of their exchange rate liquidity, their interest, their funding liquidity, etc., etc. For that purpose, it has to have an external focus. If it does not look at that aspect of the business, and it depends on the other functions to do that, then the other functions do not have the skills and the know-how to manage that part of the business. So, for example, if you have a trade client who calls RM sitting at corporate banking or at retail banking or personal banking or one of the other sections of the bank and says, look, can you tell me what's happening with the exchange rate? Should I be buying today or should I be selling dollars today, or what's your view on the sterling against the US dollar? Is it going up? Is it going down? When should I do what? Now, the guy sitting in that department, you can't blame the guy. He wouldn't know because that is not his business. Yeah. So he doesn't understand that what needs to be told to the particular client, right? So that responsibility falls upon the Treasury team, basically, and what they do. So ultimately, Treasury has to face clients as well as manage internally with their the stakeholders inside as well. So there's an internal as well as external responsibility or function that the Treasury Department has to undertake, basically. Is that clear?
Yes, sir.
Yeah. So in the discussion we had that day, we discussed a lot about liquidity and managing the bank's liquidity. Why is it important to manage the bank's liquidity? And what is liquidity? Liquidity versus profitability, if I'm not mistaken. What's the difference?
Liquidity is the possibility to turning into cash of bank's assets without occurring higher cost. It is important because the bank is holding someone else's money and assets. So on demand, we need to pay these debts. Otherwise, it will affect the bank as well as to the banking system.
Okay, fine. Any other answers?
High liquidity, low profit.
Sorry, I didn't get you, please. Liquidity is?
If we maintain a high liquidity, we can't expect more profits.
Yeah, I mean, if you take it that you're not, if those liquidity. Okay, so when you say liquidity, what are we referring to here? Are we referring to hard cash in the bank vault or in the central bank account that's not earning interest? What are we referring to as liquidity here?
So cash and cash equivalent.
Yeah, so if I say you have a treasury bill, are you liquid?
Yes, it's liquid.
Yeah. So now what happens with profitability and liquidity? You mentioned that if you are liquid, you are not earning enough profit. Is that 100% correct?
No.
No.
It should be managing properly. The liquidity is the way of getting profits.
Okay. Yeah, so it's about maximizing profit, right? So basically, let's start at the thing where you say, look, profitability and liquidity go hand in hand, yes, but you can be profitable and not liquid. You can, basically fall into trouble even if you are making profits if you are not maintaining liquidity. Yeah. If you are maintaining liquidity,
Yes.
there is a chance that you are also giving up profit to maintain that liquidity, because you will have to manage it in such a way that you have liquid assets. Therefore, you are not maximizing on the opportunities to make a return. Do you all agree with that?
Yes.
Yeah. So liquidity is important because liquidity ensures, like somebody already mentioned, that the bank is solvent, that it has enough of funds to meet a client's requirements in a short notice. So there are various liquidity ratios that have to be maintained in a bank, and those ratios ensure that if the bank were to go into a stress scenario, that the bank has sufficient funding to provide to their clients. Now, that liquidity does not necessarily have to be kept in cash. Of course, that money, there is a percentage which is kept as reserves. As reserves, but it does not mean that the whole quantum has to be kept in cash. It can be kept in cash equivalents and liquid assets. So the more liquid, the more risk return, risk-wise less asset is, the less the return on that particular asset is. So, for example, if you have Nostro dollars and you are parking it in US Treasuries, US Treasuries earn nothing, basically zero, right? But it is one of the most liquid asset you can get, highly rated liquid asset. Same in Sri Lanka. If you have Sri Lankan rupees and you put it on a repo or treasury bill or whatever it is, you are getting a lower return, but you have a more very liquid asset on your books. Now, what is the downside of liquid asset? Is the profitability. So you could probably give a loan to one of your clients at 10% interest rates as opposed to putting a treasury bill at 4 or 5%. But given the rating of the client, the tenor that you're giving the loan for, and all the other risks that you're taking, it may not fall into the category of a highly risk-weighted, highly liquid asset or liquid asset. So you have that issue. So when you're looking at liquidity, very briefly, tell me what are the aspects of it that you look at. What would you consider when you're lending money and when you're considering maintaining the bank's liquidity? What would you look at?
Tenor, sir?
Sorry?
Tenor, the period we going to lend?
I can't hear you, sorry, please, if you don't mind.
The tenor of the or the period?
Very good, very good. What else? What else?
So ability to repay.
Ability to repay. So when you say ability to repay, what do you mean?
That means if we have lent money to someone, he will be able to repay the loan on timely manner. Otherwise, we can't.
How do you gauge that? How do you gauge that ability to repay?
His income.
His income, okay. No, okay. So if you take a corporate or a company or institution that you're lending to, right? What is the first thing you look at when you're looking at the ability? Okay, you have a project, you have a project that he comes with. He wants funding for that. You look at his balance sheet, you look at his project, and you say, okay, I can lend to him, I can't lend to him. Okay, but other than that, when you're considering a guy, when a regulator is looking to see whether you have enough of risk-weighted assets, what are they looking at?
Their cash flows?
No, before all that. Now, if I go and show my balance sheet to a shareholder and say, okay, this is my assets I have, my liquidity ratio is so and so, and these are the assets, he's going to ask you what are these assets that you have? How are you going to explain it to him on an overall perspective? So you're going to tell him, look, I have X amount of treasury bills. I have X amount of debentures that I have given to AAA corporates. I have X amount of funding loans, debentures that I have purchased from BBB corporates. I have X amount of money lent to my corporates who are my bank's customers, like, you know, people who have come for projects and stuff like that. You know, that kind of thing. So, but basically, you know, those kinds of details are what is there, and that determines from that balance sheet how your liquidity asset ratio is comprised. So, I'll give you an example. Forget about specifics. Bank has 100 million, say 100 million rupees. It has given 20 million on treasury bills for 1 month. It has invested 20 million on treasury bills for 10 years. It has invested 20 million on treasury on corporate debt for 10 years. It has invested another 30 million on corporate debt for or short-term facilities for 1 month. Yeah. So it will give you a composition of your where these funds have been deployed, put into. Yeah. And it will then tell you, it will say, okay, based on your composition of your assets, your liquidity is X. So if the liquidity ratios drop, then suddenly somebody will say, look, all those 10-year corporate debt that you have, they are not liquid. There's no secondary market. You can't sell those assets if you need to go get into money. Your 20 million you have on treasury bill short term is too little. You need to increase that a bit more. Or you need to have something other than that that's equivalent to that. So they might ask, looking at treasury, looking at that, might say, okay, let's get rid of this and put this on our books. Overall asset composition could be the same. Asset volume could be the same. It's just that how it is broken up can change. So that management of that while making a profit, remember that always, while making a profit is what Treasury has to do. And obviously, in part of by managing liquidity, it has to manage funds. So when you say fund management, it's about making sure there's a daily requirement of cash for the bank. The people are withdrawing money and depositing money, and it's a constant. There's clearing, there's trade, there's all the other functions, forward maturing, etc. So you have to make sure that those cash flow requirements also are basically looked after whilst doing that. Is that clear? So, is that clear? Any questions from last week?
It's clear, sir.
Hello. Okay. So with that, we jump into today's one, which is basically on reserves. We are discussing two types of reserves: operational reserves and legal reserves. So operational reserves. What are operational reserves? Says on the slide, but please tell me in your own words. What are operational reserves? I just finished talking about that, and I sort of brought you into this topic now. So when you say operational reserves, what are we talking about?
Whatever excess funds we have parked, sir?
Whatever excess funds you have
Other
parked.
than
What do you
legal
mean by
reserves
excess funds?
that bank might, that means other than legal reserves that bank might have excess funds, then where we park, is it in treasury bonds in short term, it's in long term, or debentures like that?
Yeah. So, okay. So let's take that. I'll ask you a question. What are legal reserves?
That is mandatory requirements that based on the central bank. Time to time, they have imposed certain reserves to be maintained with central bank.
Okay.
Like SRR, like that.
So what is the SRR now? 2%, right? Hello. Hello?
Yeah, can hear, sir.
Okay. SRR now, what is the SRR now?
2%.
2%. Right. Okay. So basically, the legal reserve in the case of ours will be the reserve at 2%. We discussed this last week as well briefly. Why they start with the legal reserve? Why is there a legal reserve maintained by the central bank?
In a situation of insolvency, to settle the customers.
Yeah, more than insolvency, it's also to do with liquidity, isn't it? So that the bank doesn't.
Yes, liquidity management also.
Yeah, no, bank doesn't lend 100% of what it has to its borrowers. It basically manages to keep some cash flow so that if it is so right now, and by managing the reserves, what does the bank manage basically? Liquidity is one thing, but what other aspect of it does the central bank try to manage by managing the legal reserves? Comes back to money supply. Yes. So amongst the tools the central bank uses, they use their reserve rate. So in other words, their repo, reverse repo, or funds rate basically to manage interest rates and thereby make it attractive or not attractive to hold funds for the bank or lend to the bank and people to borrow. They use their reserves to sort of manage the liquidity in the market and the multiplier from that point onwards. Separately, they will use other functions like fiscal side of things, reducing taxes, regulating certain aspects of the market, etc. To manage the amount of liquidity that's there in the market. So in legal reserves or reserves is one way of figuring out, okay, how much of money do you want? So we've had in Sri Lanka money that central banks want in circulation over a certain period of time. We've had reserves as much as 10% when there was high credit supply. When private sector credit growth was growing at like 30-35%, and obviously there was a need to bring down interest rates and manage the cost of rates. We've had where deposit rates were again or interest rates were taken up, as well as reserves were kept on the high side, so that the cost to the bank by keeping reserves was high. So when I say the cost to the bank by keeping reserves is high, why is it high? That when you have to keep legal reserves, why is it cost to the bank?
Zero interest.
Zero interest. So the more you keep, the less you earn. Yeah. So the bank does not want to keep reserves. So when there is a cost like that, ultimately, who does that cost go back? Get transferred to?
Yes, to the customer.
To the customer. So which basically means that ultimately either through the deposit rate or the lending rate, whichever way you want to look at it, that cost of the reserve is built into one of those interest rates. So going back to operational reserves, let's start there. What are operational reserves? So basically, it's not only the reserves that are kept because of the legal requirements of the market that you're in. Basically, it is reserves that the bank itself might decide it wants to maintain. So in other words, cash flow. You might have a reserve requirement of 2%, but you might realize, no, I need to keep another 1 or 2% aside to meet my obligations that are coming up in the next few weeks, months, whatever you might say, right? So you might decide to keep more than the 2% to meet those requirements. Yeah. So that, how do you gauge that? How do you figure out how much of money that you need for that purposes? How would you figure out how much? Sorry?
With the past records?
Yes, past records of what?
The withdrawals and all.
Yes, and then what else? So you do a back testing. What else do you do?
And future maturities of deposits and other maturities on other financial products.
These are opportunities, right? You're talking about opportunities, right? You said opportunities, right?
Right.
Okay. What else do you look at?
Lending projections.
Okay, fine. That's also good. Yeah, so you do all that, but you also look at actuals. Remember, you have the MI already, right? So for example, yes, you project, you look at the back test and look at to see, you know, how much of deposits you had in the month of April every year for the last 10 years, okay? How much of borrowings you have, fine. You look at your cash flows in the future and say, okay, I have X project which needs 100 million, another project which is another 50 million, and you project. Those could happen, could not happen. So we don't know, but those are projections. Fine, fair enough. You probably can weight it in terms of probability of happening, you know, that kind of thing, and then decide for yourself, okay, this is a project that might happen. Let's give it a 70% probability, and then place 70% probability of this money going out of the bank. Okay, but you also have actual data, right, of the future. You have a list of time deposits that are going to mature in the next 3 months, loans that are going to be paid off in the next 3 months, 6 months, 1 year, whatever, right? You know, you have that data from your already existing MI. So you know for a fact that there could be a client with 100 million deposit due in 3 months time, yeah, and you know when that 100 million goes from your books, okay, you realize that it can have an impact in 2 ways for you. Number one, it can have an impact on your straight away on your liquidity, because ultimately if that deposit has been a 5-year deposit that's maturing now, it would have been a very liquid asset for you. Why is that? If I say a 5-year deposit that you have is now rolling now off the books, why is it to say that it is it's a very liquid asset that's going off? What's the reason? If I say there's a 5-year deposit on your book, is it a liquid asset or a less liquid asset or more liquid asset? Liability, sorry, for the bank liability. But
Liquid asset.
liquid is liquid because of 2 things. One is deposits for longer tenors are sticky, meaning it should stay with the bank for a long period of time. Deposits that are kept for short periods, even if they are rolled over every month, can be taken out at any time. So you can't consider them to be as liquid as a long-term deposit. Long-term deposits, people hardly take it out if they're getting good interest rates. Plus, if there is a cost of replacing that, there's a upliftment cost or whatever you want to call it, people don't generally take it. They might borrow against it, that's different, but they will not necessarily want to uplift the deposit. So those are considered, anything beyond a year, I think, if I'm not mistaken, will be considered as fairly liquid in terms of the bank's books. So a time deposit, going back to the thing, if it is being taken off after being there for 5 years, of course, as the tenor gets closer, the liquidity of that, you reduce the weighting of that, obviously. But say it's disappearing in the next 3 months, you are losing a liquid asset, a liquid liability, sorry, and you are losing, you're going to lose cash flow, right, on that day, 2 things. So you need to figure out how do I operationally, how do I make sure that I have enough cash flow for the day, for that particular time period of time, and how do I prop up my liquidity in the process of doing that. So how would you do that? If you looking at this and you see this big thing in your balance sheet, how would you manage that? Yes, answers. How would you manage that? Hello.
So accumulating new time deposits.
Oh, okay. What else can you do? Yes, you can accumulate new time deposits, fine. That will sort out what? The cash flow issues or liquidity issues?
Cash flow issues.
You could also sort out the liquidity issues if you get another 5-year deposit or something similar to that. It could also sort out the liquidity issue depending on the type of deposit you got. What else can you do?
Charging a P&L charge.
Charging a
P&L, right?
P&L, meaning?
Yeah. A rate which is lower when early maturity.
But if it's maturing normally, we can't charge him anything, right? It's his deposits he's taking back. Okay, the other thing you can do is on the asset side, where you can actually manage your funding to funding book, or rather funding book, your lending book rather, and basically say, oh, look, I had this loan which I was giving out to X customer for on a 3-year basis or whatever, which is coming up maturity as well. I can't do that. Or even if you have some short-term lending that you're giving, you have to take it off the book. So that's not ideal because that's where you also generate income. So you don't want to really go out there and take something that is giving you some income off your book. But that's possible, and that will have an impact in 2 ways. One is obviously on the liquidity, and the second aspect of it is if you have to ask that guy to repay the funding to you, repay the loan, that will bring money in as well. So two sides of the balance sheet: deposits, lending. You can either if the deposits are going out, you can manage it with new deposits, or you can manage it from the lending side to manage the portfolio you have there. Now remember, it's not as simple as that. You will discuss this later on, of course, as well. Your lending tenors could be different to your deposit tenors. Your lending, that's why you have gaps. You have gaps where your deposits could be shorter, your lending could be long term. Your lending could be short term, your deposits could be long term. So either way, there will be gaps to manage. So you cannot necessarily say, oh, my deposit is maturing on 3 months in next month. There's also a lending that I've given for that. So net I'm okay. No, it's not. You could lose the deposits and you could have your lending on your book still very much forward. So you can't necessarily go to a client and tell them, oh, look, I need to take your loan back. Please pay me back. You can't do that. It hurts business and it hurts reputation and it hurts the client as well. Obviously, it could hurt the client as well, and your commitments are more. So if a deposit is maturing, you have to know early, and then you have to be able to take precautions early as to say, okay, that deposit is maturing. How can I fund that back? Can I take new deposits for that? Can I take the lending? Can I take away some short-term lending that I have, not one, but maybe few of those lending that are not that important and take it off the book? Or can I find other sources of funding for myself, interbank funding, lines with other bank, other non-bank financial institutions, whatever it might be, in order to get funding into the book. So that's where, if you lose a deposit, where can you go to for funding ultimately, if you don't have any other sources?
That is the asset side.
Borrowings.
Yes, where can you go and borrow from if you don't have any other counterparties to borrow from at all?
From the central bank?
Central bank, exactly. You can go to the central bank reverse repo window, or you can go to central bank as a lender of last resort, but basically, and use the bank rate. So in other words, central bank becomes a source of liquidity and funding for you in a case where you have a mismatch in your balance sheet, which is often the case, nothing unusual in that. Then you pledge your treasury bill portfolio or part of it to central bank and basically borrow against that. Yeah. So operational risk is basically this, where even if you don't, there is no statutory requirement or beyond that, you must still keep parts of your fund, your deposits or your funding that you have got to meet your obligations that you will have. And remember, these obligations, I mentioned mainly from the balance sheet, but if you really look at it, you have salaries and other expenses that you have as well to run the bank. Those also require you to keep funding like any other organization that has a cash flow requirement. So we discussed all this already, but let me just go through it. When you consider deciding the levels of operational reserve, in other words, what you need for your own operational requirements, you need to then figure out a few things. Quality of your current portfolio assets that you have, the risk you're exposed to, your ability to go out and, like I just mentioned, go out and borrow funds if you do not have enough reserves at any given time. How much of your loans are long-term, how much of your deposits are long-term and short-term, etc. The information you have and how accurate that is, and obviously your geographical diversification. So what is it all trying to tell you? It's all trying to look, you need 100 million, your reserve is 2%, we'll say that's 100 million. You figure out you need another 100 million daily to manage, or 50 million daily to manage, or whatever it is. So you decide for yourself, okay, I'll keep my 100 million reserve, I'll take another 50 million, I'll keep 50 million. But obviously, you don't want to keep that 50 million because that's not earning you any, the optimum level of return that you would like to, where you would like to lend that to a client, you would like to invest in some other activity of the bank that will get you more return for the shareholder. You need to figure out, okay, I need 50 million, but can I only need 50 million in 2-3 days time. I don't need it right now. I need it average 50 million. So one day I might need 10 million, another day I might need 60 million, 70 million. So there's no point in me keeping this whole thing throughout. It's not fund management, right? Then what do you decide? You look at the whole world around you and decide, okay, I need 10 million tomorrow. These are the assets I have on my book. How much of those are dropping off? How much of those can be liquidated? This is the capability I have of going to central bank or to interbank. I have enough of lines, enough of what do you call those funding lines from the interbank market to go out and borrow money. So I don't need to keep 10 million. I am pretty confident if I need to go out there and borrow, I can do that. And then, if, for example, if we are talking, foreign currency driven lending, etc., borrowing or whatever, even if I can't borrow from my Sri Lankan funding, okay, please, I can go to, we'll say, my officers in Dubai or India or in another part of the world, London or wherever you want to call it, or my counterparts I have there, and I can borrow from them, even if I can't borrow from Sri Lanka. because I don't have dollars, right? So how diversified is my book? So it depends on how much of funding sources you have as well, ultimately, and how diverse they are, where they are located, and in general, the liquidity in the market. If the liquidity in the market is poor, and you can't raise liquidity in a hurry, and you do not have enough counterparties, then of course you have operational reserves as well. You have operational requirements as well. Then you would maintain a good buffer to manage the future requirements without taking any chances that you will have to go out and rely on other people for funding. That is not the best option because that's going to cost you in terms of not managing your funds properly, in terms of not making the optimal return on your funds. Yeah, so information systems, like I said, is very important because it tells you what you need, how when you need it, and basically helps you to keep less, more than you require. Yeah, so geography that I mentioned, one branch, one bank with 100 branches all over the country. So obviously, the second one needs more liquidity, and that has to be managed. Yeah. Okay, so going back to operational thing in terms of reserve requirements, and it's a very basic question. If a bank had only 5 deposits with large accounts and 10,000, which one will be at more risk from these two? Which is a better option?
Second one would be a better option.
Second one. Why second one?
Because the depositors, like, they would be less impact. There would be less impact if individual people opt to take their money out. But
that's right.
Less concentration.
Yeah, it's basically you're sharing the risk. That's right. You're both right. You're sharing the risk, right? So you would rather have 10,000 depositors with small accounts than 5 depositors with large accounts. So there are various ways of looking at this, right? So yes, you would like to have 10,000 depositors and whatever, but obviously administrating these depositors, managing these accounts is going to be a bit of a nightmare, right? So you need to then have the whole infrastructure around that. Right? 5 depositors, and this is extreme, it's obviously not going to be this thing, but just looking at it very, very simply, 5 depositors, easy to manage, less staff, just have to manage 5 people, and that's it. But if those 5 people take one of them, you're losing 20% of your deposit base. So that's a big problem. But in most organizations, in most banks, you'll find that yes, there are, whatever, 100,000 depositors, whatever it might be. But you'll find that the 80-20 rule applies. Yeah, the number is high, but you would probably get the top 20% that has the majority of the deposits in the bank. So as much as there are more depositors, the volume of deposits will be concentrated amongst about 20% of the population of the bank's depositors. And not only for deposits, if you look at the overall business of the bank and you look at the balance sheet, you look at their P&L and stuff, you'll find that about 20% of the income of the bank, even the lending side, will be concentrated amongst 80% of the revenue will be concentrated probably around 20% of the clients the bank has. So it often happens that way. So there is always, there should be a differentiation of how you manage each of these clients. And I don't think it's necessarily wrong to have 5 depositors, but you need to also have the 10,000 depositors as well to manage the whole risk portfolio of your book. But sometimes it's inevitable that you have a few big people or institutions and banks, institution and depositors, who will be the majorities of the people who sit in your balance sheet. So we've done this, so we know what statutory reserves are. It's what you are supposed to keep because of statutory requirements of the bank, of the market you're in. So this is the example of what. Sorry, go ahead.
So this Basel requirements and the IFRS requirements, can we treat it as a statutory?
That doesn't come into statutory. That will come into mostly your capital requirements.
Okay, so thank you.
Yeah, so that would determine, for example, there's Basel 1, 2, and 3. So it will determine how much of capital you have to keep in your books prior to you lending to somebody, lending to not somebody in terms of that, but basically overall on your balance sheet. So for example, you might have a tier 1 capital of 12% in your books. If you're lending, that exercises that you take bring your tier 1 capital down to 10%, then you have to find ways of shoring the capital up. So basically what he's trying to talk about there is solvency. He's trying to say, look, you have X amount of capital deployed in this company, in this bank. We want you to make sure that when you're lending and you're lending to somebody, you take into account the risk weighting of that company based on their rating, whatever. You take into account the tenor, and you have a weightage onto that capital, weightage onto the lending towards the capital that you have put into the bank, and then you keep aside this amount of capital, and you then lend. So you have something called risk-weighted assets. So every loan that you give is weighted in terms of their risk weighting. So the lesser risky loan that you give. So you buy a treasury bill, for example, that amount of assets, risk-weighted assets that you have to allocate towards that is less. The higher the risk, if you have a BBB rated 10-year bond, the amount of assets, i.e. the amount of capital you have to set aside for that, risk-weighted, is higher. So the bank, when they are lending, then they have to be careful onto what kind of rated or liquid or risk type of asset they lend to. That way, what they're trying to make sure is that if there is a run on the bank, if there is a liquidity requirement, if there is a downgrading of whatever, that the bank remains solvent, because the type of assets they have lent to are not very, very risky. And this came in several iterations. Last one came after the 2008. It got more stringent after the financial crisis in 2008, where the banks were lending to groups of lenders who didn't have the capacity to pay back and were not highly risk weighted. So they realized they need to tighten the rules in terms of who you can lend to, and if you are lending to people like that, how much of capital you need to set aside for that, and that way manage your capital adequacy ratios. So that has nothing to do with the day-to-day. It can have impact, but at this discussion, it has nothing to do with the reserves you maintain. Reserves are about today's liquidity and how much the central bank of that particular country wants you to maintain. Those are reserves for cash flow purposes, for liquidity purposes immediately, not necessarily to make sure that you are solvent or as a going concern or throughout a period of time. Is that clear?
Yes, sir. Thank you.
Okay. So so in this example, the reserve requirement is 10%. Bank maintains 12%. Bank B maintains 10% as required which exceeds the 8% operating. Yeah. So there are two banks here. One is maintaining 12% when the reserve is 10%. The other one is maintaining 10% and the operational reserve would otherwise maintain 8%. Yeah, the actual requirement for operational purpose is 8. But they are maintaining 10. And other one is maintaining 12 when their actual requirement is 8. So it all depends on what your requirement is and what you want to manage with that. Okay, questions. We'll go to the other. I'll basically what I'm going to do is I'm going to do another part of the other section also after this. But before we get into that, I have a few questions on this side. We finish that, take a break in a few minutes, and then come back to the next set of slides. Yeah. So questions. The amount of operational reserve is determined by whom? Operational reserves. Huh?
Commercial banks.
The commercial banks, yes, correct. That's right. Number 2, the purpose of operational reserves is to what's the reason? Pay for computerized account system, preserve 100% of lending, provide financial payments always, meet legal requirements.
C.
3. Any other?
C.
2. No, why do you say 2? Okay, let's see the answer first before going on. Okay, 3 is the right answer. So why not 2? Why not 2? Can a bank at any time preserve 100% lending capacity? Can I always be ready to lend 100% of what I borrow?
No.
You can't, because you will always have the which reserve there?
Statutory reserve.
You have the statutory reserve, and also your operational reserves can exceed the statutory reserve. So you could have a statutory reserve of 12% or 10%, but you could have operational requirements of 15%. So there is no way that you can lend out 100% that you borrow, but you can lend everything that your customers want by again going out and reborrowing. So you by maintaining that gap, central bank makes sure and other regulators make sure that you have cash flow remaining to give your depositors back. Because remember, we have a duty of care towards our depositors, where you are always want to make sure that they have given you your money. I mean, we discussed it on the day 1, right? Depositors gave money to us on the basis of trust. If not, depositors would go out, find their own lenders, borrowers rather, and give money to them, saying, okay, this is the money that I took from you, I'm giving you, please give me back with 10% interest. That doesn't happen because one is they haven't a platform to do that in, the other access is difficult, and the second reason is they trust banks. But to preserve that trust, whenever they come back and ask for their money back, we should be in a capacity to give that money back to them. No questions asked. We might charge them for early deposit, withdrawals, whatever, but the money has to be given back to them. There is no, it's called a demand deposit for a reason. Yeah. So that is very important to understand that that capacity has to be there. Which bank needs the most operational reserves? One branch bank, automated bank, 1 million customers, manual system. Which bank needs the most operational reserves?
Manual system bank.
Sorry?
Manual system bank.
Okay. Any other answers?
C.
3. No. This is manual system bank. Sorry. Why? Because why is that?
Because they can't predict the requirements like an automated bank, right?
That's right. So why can't they predict the requirements? Future requirements, or what can't they predict?
They wouldn't be able to see the current their position correctly, and they could be delays like getting the information, and also that would lead to future prediction getting incorrect.
Right. So you're right. So basically, the bank will not be able to see what you're looking at the systems. They can't see exactly project what their future deposits, lending maturities, trade requirements, all these forward maturities, all that they can't see. Secondly, like you said, projecting new business also will be different because the MI for that may not be there. So the more manual your systems are, the more difficult it becomes to project that. Second thing is, when you have manual systems, you also leaving much more room for operational risks, where somebody could put an extra digit in a ledger somewhere, or type in the currency wrong. So you have what we call fat finger operational risk from errors that are human, but basically can cost the bank in that way as well. So there are difficulties in manual system banks. So the better the systems are, the more efficient it is. So obviously now you'll find there are more and more platforms. This if you look at this peer-to-peer platforms and so on, all those are on apps and digitally, right? So all automated. What they have that are the most banks and most people in the world are slowly getting into is the ability to digitally manage data. There's a lot of data in those systems that help those platform providers to project what the requirements in the future, what the liquidity is, etc., etc. And then the more people start using it, the more data gets into that, and the more data can be projected through algorithms. So basic thing, the more data you have, the more systems you have, the more efficient your projections and ability to understand your requirements are.
Sir, I have a doubt regarding that question.
Tell me, please.
Is that practical in current context? Because all of the banks become automated. So is this practical? This thing?
Sorry, I didn't get the question. I didn't get the question. Tell me again, please.
As all of the banks in current context became as automated, all the process. So this question, this question is practical in current context, or?
Okay, so what you're saying is this question practical given the current situation in the banks where most of the banks have automated, right?
Yes, sir.
Okay, no, you're right. So I think you're taking in the context of what has been said. So there are different levels of automation. So I agree with you. I don't think any bank now is manual, right? So when you say manual, I think you have to take it in terms of how automated is a bank and the quality of the systems they have. Let me put it that way. So for example, you could have a bank that has the best systems in town and the best processors. So therefore, they can project it with one person sitting at a desk. They can look at everything and say, okay, these are the cash flow requirements. Yeah. But you could have a bank that has some of their systems that are automated, but some that require manual intervention still. Yeah. And because of that, their systems may not have been efficient as the one that has all that automation in it. So I'll give you a practical example. I worked for HSBC up to the end of this last of January, as you know, and basically they had some super systems in terms of managing cash flows, projecting all that. But even there were certain aspects of it which still required, because one system would not sometimes speak to another system. So there was a bit of manual intervention that was required to take data from this system into that system and then say project, what it was or whatever it is. But some banks could have fully straight-through systems as well. Some of the local banks, some of the systems could be where it is automated again up to a certain level, and again there has to be a sort of a manual intervention some point on it. So I agree, nobody's sitting now and doing ledgers and doing those. That would be surprised if any bank is still doing that. But that degree of manual work will still be there to an extent, at least in the local banks. Now, if you go overseas, obviously the guys in London and Hong Kong, most of these processes will be streamlined straight through. Yeah. But I'm pretty sure that if you go to certain outside areas of, say, the US, or even in the US or any other country, there are still banks that have a lot of older systems and older processes that are manual. So I think that aspect of it is still there to that context, basically.
Thank you, sir.
Legal are constant from country to country, set once and never change, set by commercial banks in existing operational risk, set by central banks. That should be easy. Which one is it?
D.
D.
Last one.
D.
D.
D. Okay. Yeah. That's it for this session. Any questions on that one?
Excuse me, sir.
Sorry?
Excuse me, sir, can you explain that slide 14?
14, 1-4.
Yes.
1 second. 14.
Yes.
Sorry, my system is taking a bit of time. Hold on. Yeah, so this is what you have, saying that look, you're supposed to maintain a reserve of 10% from a central bank perspective, but your operational requirements are 12%, meaning that you are keeping cash flows of up to 12% to meet your overall operational requirements. So you maintain 12% instead of 10%. You need 2% more than you maintain on your books, right? The second bank has only a 8% requirements. In other words, its operational requirements are very less. There are overheads, there are, other requirements that they have over the next is only 8%. But the central bank requires them to keep 10% anyway, so they have to keep a reserve of 10%, which exceeds their statutory reserve requirements anyway. So if you look at the slide, you will understand it. This is the operational in green, and this is the statutory requirement line here in the 10. But whatever happens, whether you have 8%, 12%, the minimum is 10. Beyond that is your own requirement that you're maintaining. And remember, these operational reserves, you keep reserves overall. Yeah, so you keep the 10%. If you need more, you keep more on top of that. You don't keep 10% as well as another 12%. Now, the money that is kept there is a reserve, meaning your cash flow requirements, you're meeting beyond this. You're keeping this reserve and then keeping your cash flow requirements on, meeting your cash flow requirements on top of that. Why are you keeping this reserve? As a buffer. So that, for example, if you have operational requirements of 12%, that is already built in. You kept the 12%, your cash flows are all built in, but you're keeping the 12% and then doing it, right? Most banks would not want to keep anything beyond the 10%. So even if the operational requirements are, 12% like here or 15%, they would like to keep the 10% and the 5% manage it with the cash flow they have. That's why the MIE and everything is important, because they don't want to keep that additional reserve. But if they feel that, look, I find it difficult to find money when I need it, I don't have counterparties, etc., then instead of keeping just 10%, they'll keep 12%. But if they need to exhaust funds, then if they need to use funds, they can go down from 12 to 10 in order to meet the requirements, but they can't go below 10 because 10 is a legal requirement, reserve, statutory requirement, right? But they can exhaust another 2% to meet that requirement. In this guy's case, he can't go to 8 anyway. He can't go down because he has to keep 10 anyway. So his requirements are here. If he drops and, if his reserve, if his operational requirements go up to 15%, he doesn't have a buffer, because he's not kept anything, because he's projected his requirements at only 8% and kept 10. He can't go, you can't use anything beyond this, below this line. So why this is there is to show, look, I have a statutory requirement of 10, operational requirement of 12. Okay, so I'll keep 12%. Fine, I won't keep 10. But he can only use 2 if he really needs to. And these are reserves. Remember, these are reserves. These are not to be used. So the using of it is purely become discretionary if you have to use it, not ideal. But this you can't use at all. It's illegal for you to do it. This you probably have the option of using it, but with good reason. This bit 2% here. But these are reserves to maintain. Is that clear? Sorry, I can't hear you, please.
I lost my internet connection. I couldn't hear you. Sorry, I just got reconnected.
Sorry, I can't hear what you're saying. If you can speak up a little bit.
I lost my internet connection. So I
okay. Now or earlier?
Now.
Okay, so now can you hear me?
Yeah, okay.
Yeah, so the operational reserve and the legal reserve. So basically, the 10% here go back. Okay, so this 10% is the legal reserve you have to maintain whatever happens.
Yes.
Is that clear?
Yes. Okay.
Yeah. So the operational reserve in this bank B is only 8%, bank A is 12%. Right? Meaning that the bank A has to maintain above the legal reserve as well. So instead of maintaining 10%, they maintain 12%. Bank B has to maintain only 8%. But because the legal requirement is 10%, whether their operational requirement is 8, they can't help it. They have to maintain 10. Is that clear?
But the operational reserves and statutory reserve are 2 different things. So it has to be 2 percentages, right?
No, that's what I'm saying. That's what I'm saying. What happens is the bank will not maintain 2 percentages. They will maintain everything as one part of reserves. However, if there is a situation where they need to, because these are reserves, right? So what it means is you're not maintaining 22%. You're maintaining 10%, you're maintaining 12%, or you're maintaining just 10%. You're not maintaining 10% plus 12%, 10% plus 8%.
Okay.
You're maintaining one, because if you are going to maintain 22% of your deposits as reserves, you're going to be in trouble. Yeah, or 18%. So what the bank does is it keeps the minimum, and it keeps, if it needs to, if it feels that it can't fund itself in the market and it has operational requirement of 12, they'll keep up to 12, but they can probably use up only 2%. They can't go below the 10%, because that's legally not possible, right? But the reserve is maintained for 12 based on projection. That's why projections are important. So most banks would want to maintain only their SRR. They wouldn't really want to keep reserves aside separately for their operational. They will manage that on a day-to-day cash flow perspective. Only if they find it's difficult for them to find that cash flow, then they would keep an additional buffer as reserve. Or for if there is a internal requirement where they have to maintain that, they will maintain that percentage over and above the statutory reserve requirement.
Okay, sir. That means they have to maintain whatever higher amount, is it?
That's correct, 100% right, yes. Okay. So what they have to maintain at a minimum is their legal requirement.
Okay, sir, thank you.
It's kind of a buffer, no, sir?
It's a buffer. So yes. What I said was like the reserve is kept, but they have to manage this on a cash flow basis. It's a reserve. So you wouldn't want, you would like to have reserves, but the more reserves you keep, the less money you generate from, because it's idle funds, right? End of the day. So you don't want to idle funds. You want to maintain as close to whatever requirements are as possible. And that's why, like I keep saying, if you have sources of funding, if you have cash flow things, you would keep less reserves and manage it on a day-to-day basis. Where the market is not liquid, where you don't have counterparties, you can't grow liabilities in a hurry, then yes, you would keep a bit of a buffer there. Okay, so I'll stop there for the moment. We'll take a break, and when we come back, we will do we'll do part of this presentation on liquidity again. This will, we'll do part of the presentation on liquidity as well. So about 15-20 minutes, we'll be back. Yeah.
Okay.
Okay, sir.
Thank you.
Yes, sir.
Hello, sir.
Hello,
Okay,
sir.
can you see me, hear me?
Yes, sir.
Okay, good. Right, now let's get into it. Right, so we completed the section on reserves in the morning on how it works. Now we're going to do a section on liquidity management. Yeah, that's right. Can you see the screen?
Yes, sir.
Okay, great. So basically, I've touched on this briefly when we were doing the section on reserves as well. I'm just going to complete that section. We will go up to, we won't finish this whole presentation today. 1 second. We will go up to the section on
So this is presentation, treasury management, part 3, right?
Part 3, that's correct.
Thank you, sir.
Okay, we'll do this. We will continue on this. We'll see how far we can go because I don't want to rush through it. We have time, but we will take it slow and we will try and finish off at least half of this presentation. If we can finish the whole thing, we'll do that. But objective is to try and learn the differentiation between liquidity management through your assets and your liabilities, and how you make sure, like I said earlier, if you have a liquidity requirement, how you can manage that by looking at both sides of your balance sheet, not only one side of it. So, like I said, objectives differentiate between managing liquidity assets and managing liquid assets and managing liquidity liabilities. The costs, recognize the costs related to that, and try to figure out what a negative gap is and a positive gap is. Recognize the reasons for having a negative reasons for having those gaps, the risk coming from those gaps, overbought and oversold positions, especially in terms of foreign exchange, and basically the strategy of creating net exchange position. Okay, and then capital and capital hedging, etc. So we already discussed liquidity management, but just to touch on it again, we can manage liquidity from the asset side, basically the loans the bank gives out and the assets the bank creates, or we can manage on the liability side, which is basically from the deposits and the liabilities it generates. So if we are looking at both one side at a time, when you say you're managing from the asset side, we've touched on it. So what can a bank do to make sure that it's considering liquidity when it's managing it from the asset side of the book? When it has liquidity on its mind, what kind of assets should it be look at generating? What kind of assets should it be look at generating? What should it look at generating? When it has liquidity on its mind, what kind of assets should we look at generating? When the bank has liquidity on its mind, what kind of assets should it look at generating? That's the question.
Short-term loans.
Short-term loans. Okay, good. What else?
The cost, sir.
Overdraft.
Wait. When you say cost, why do you say cost? How does cost impact liquidity?
When you are trying to convert that, if you are incurring any cost.
Okay, so what's the better word to use than cost? What's the better word to use than cost?
High interest rates.
No, this is not about revenue, it's about liquidity. So I'm just going back to the cost. I think you're referring to cost in terms of, okay, if you have an asset and you need to make it liquid, you have a cost of going and cashing that asset, right?
Yeah, that's true.
Yeah. So that's called a secondary market. Having a secondary market. Example, if you have an asset that's like a treasury bill, and that you know that it can be easily converted into cash, and there is a readily available secondary market. If there is a readily available secondary market, does it mean your cost is higher or lower?
It's a lower, sir.
Lower, because you can always go out and liquidate it. If you don't have a secondary market, or you have very illiquid secondary market, what happens to the asset then?
The cost could be going to be increased.
Yes. So what do you generally have to do when you have assets of that kind? You have to keep a liquidity reserve, right? For the illiquidity of the asset. So if I were to tell you, you have a 3-month treasury bill and you have a 10-year treasury bond, which is the more liquid?
2 year.
3-year treasury bill, 3-month treasury bill and a 10-year bond, which is the more liquid?
Treasury bill.
Treasury bill, because there's a ready market for that. So if you have assets on your book that are cash or can be converted into cash easily, that means your asset portfolio is fairly liquid. Yeah. So when you're managing your liquidity and you realize, depending on what your requirements are in the next 3 months, 6 months, 1 year, whatever period you want, you can position your assets. And again, I'm not talking about profitability here. I'm talking about liquidity, right? So if you find out that your asset portfolio is liquid enough to manage all your needs at the moment, then you can actually look at positioning it to see, okay, if that's the case, how can I optimize my profitability separately? Now I've managed my liquidity. Is there any new assets that I'm creating? Do I have the room to create it where it's less liquid, more return for me? Does that make sense to you? Is there any question there, Phil? What I'm saying is, you look at your assets right now, you find that you are fairly liquid to meet your future obligations. But as a bank, you keep on, it's an ongoing thing, right? You keep on generating new assets. So if you're fairly confident about the asset portfolio you have now, you decide, okay, I have some excess deposits or liquidity that I've generated. The new assets I'm going to create, I don't need to put it into as liquid assets as I can. I can hunt for some illiquid assets, which will give me a higher return and thereby earn more profitability. Can I go out and do that? I might consider that. Can you all agree with that or disagree with that?
Yes, sir.
Yeah, you can do that. Yeah, can be done. For that, you need good MI, like we mentioned. You need to understand your future requirements and you need to have the ability to forecast, right? Now, once you do that decision, obviously, once you put that asset on your book, that illiquid asset on your book, again, the next day, next month or whatever, your profile can change again, right? So you need to be able to project by putting that asset on your book, how your liquidity profile will look once you have that asset on your book again. So you need to be able to project based on that asset coming onto your book again. Okay, what does that do to my liquidity, right? Now, if I were to say, look, you've done all this, and then suddenly, like what's happening with COVID now, yeah, you suddenly have a pandemic like this, or a market event like the financial crisis of 2008, or you have, some other, external event that comes and causes a situation in the market. Yeah. Then what happens to your projections? Then what happens to your liquidity, etc.?
It's going to be weakened.
It's going to be weakened. So how do you make sure that for some scenario like that, you are enough of resources to manage a situation like that? If you have a situation like that, do you think you'll be able to raise, now you have created these assets, now you need liquidity, you think you'll be able to go out and borrow from your depositors fast money?
No, sir.
No, because people are going to be frightened. They may not have confidence in the banking sector. They may not want to put their money. They might want the money for themselves. So going out and raising funds in the market from deposits is going to be very tough. What's going to happen to market rates at that time? Market interest rates. How are markets going to be?
It's going to be the lower demand, and because of the lower demand, the interest rates could go down.
No, I mean, if there's an external event like a pandemic or whatever, markets are going to be very volatile, right? And your ability to source funding from these markets is going to be very difficult because it's going to be very, and you might have to pay a higher cost, and banks and other institutions might actually cut limits because they don't want to be overly exposed as well. So you might have a tough time managing the liquidity in the market, through the market. So in those kind of scenarios, the bank has to do what they call stress testing to understand in a stress scenario, if suddenly something happened, how is the bank positioned to handle that situation from the asset side? Huh? And do they have the ability? Sorry?
Bank can improve the credit quality of its assets.
Exactly. Not only assets, it can also, okay, so that's fine. So then look at the liability side. Now, I'll give you a scenario. When the credit crisis happened in 2008, and people were running away from the American banks because, you know, Lehman Brothers and all these banks were collapsing, and the credit worthiness of these banks, so all those guys have obviously created assets that were not liquid. And obviously they had a bankruptcy situation, and they relied on the Federal Reserve eventually to bail them out. Lehman didn't get that, but the other banks did. Yeah, and they all got bailed out, and eventually, you know, Fed sort of sorted them out. Till that point, nobody wanted to put their money into those banks. Everybody wanted to take their money out of those banks, right? And that's what they did. But then you found that the institutions that were not impacted by it or were of a very good credit worthiness suddenly got flushed with liquidity. In other words, they got a lot of money coming to them. So, you know, some of the banks who are not impacted, like the British banks, for example, they got a lot of money to their books. And that came because of two reasons. One is because they had already had the credit worthiness and they were actually trusted. So people bought money in and came and put it into their banks. Other one was that they realized that those banks didn't have the same type of assets on their book that the American banks had, and that they were fairly secure from that perspective. The other aspect also, but they had good capital adequacy ratios and all those things already. So people bought money in. So the banks who got the deposits had another problem. They had too much deposits. They had too much liquidity and nowhere to put that money. So they found themselves that they had those deposits. They didn't want to go and invest in highly risky assets in that time of market because it was a risk for them. So instead of going and taking all those deposits they were getting and putting it in a high yielding asset, which they could have got at that time because of the risk element in it and because of the market situation, they would go out and buy US Treasury bills, which were giving them next to zero. But they still prefer to have that than to put that money into a risky asset and find that they lost. But they had a problem where not that they didn't have liquidity, they had too much liquidity and nowhere to deploy those funds. So they are, from the liability side, they had a lot of liabilities built and not enough assets. So the assets they didn't want to put on their books at that time. So liquidity can be too much liquidity, liquidity can be too little liquidity. And even though you have opportunities to raise assets, you might necessarily not want to do that. And if you don't have liquidity, if you want to raise liabilities, you can't just simply do it. Sometimes you get liquidity when you don't want it. Sometimes you can't raise it when you want to raise it. So you have to have the ability to reach out to new funding sources, like it says here, to new markets, as and when you need. And that comes through your own credit quality and the relationships you build over a period of time. As we discussed earlier, you can't have only 5 depositors. You can't have only 1 or 2 people in the interbank market to deal with. And you can't basically have a low credit quality. If you have a low credit quality, no matter who you are, you're not going to get money, even people are good. As soon as they might bring cash and give you when markets are fairly settled and good and everything is all right, if your interest rate is higher. But as soon as market situation gets distressed, all that money is going to leave you. But if your credit worthiness is good, they'll stay with you. So, yeah, so any questions on that before I move on?
So actually, under this pandemic, I think Sri Lankan bank also face this situation because all are highly liquid because there is no any private growth in the market.
You are saying the bank's deposit base increased because of the pandemic?
Not because of the pandemic. I think even because of the pandemic, that people they don't feel any investment opportunities in near future. Because of that, they park their money in the banks, even in the equity markets, and banks also feel that there is no any growth in the lending sector. Therefore, they also park their money in treasury bills or treasury bonds or like short-term investment basis.
Very good. I'm sorry, who is this speaking?
I'm Kasun.
Kasun, yeah. Thanks, Kasun. I think very well, good evaluation there. I agree with you. I think, as you know, interest rates are at, I would say, historic lows in Sri Lanka. I mean, in my 25 years, I think this is probably the lowest I've seen rupee interest rates at. Deposit rates, 3, 4, 5%, you know, not really seen it in my lifetime. So lending rates also 6 or 7%, very low. So in that context, generally, banks will only generate income by increasing the velocity and volume of assets, not by generating deposits at 3% or 4%, because a lot of people would prefer to go for alternative investments instead of putting money in the bank for 3-4%. That's my view, right? But having said that, like you said, because those opportunities are limited and because people may not want to take too much of risk, although there's plenty of liquidity in the market, people prefer to keep their money in deposit, and banks also may not be lending as much because of the current overall economic outlook and situation. There's another factor also, as you know, there are a lot of restrictions in terms of the trade business and imports and exports, imports more than exports, import side. So, which basically means that people are not able to do their traditional businesses, whether it's importing, you know, vehicles or whether it's importing construction material or whatever it might be. So those people also have funds that they may have funds that are just parked in the bank, or like Kasu mentioned, in the equity market or something else like that. But I think the banks are flush with liquidity because of that. If not, if it wasn't for the pandemic with these low interest rates, and if the economy was opened out and we had a normal situation, by this time you will find that credit growth has picked up quite a bit, and you will also find that the banks will not have as much deposits in their books. They will be generating more assets. Obviously, generating assets come with risks, so the risk evaluation will determine how much of assets each bank would generate. But in this situation, I think the banks are quite liquid because of their liabilities, but whether they are getting optimum on their assets is a question mark, because one other thing you must realize in low interest rates is that banks generally make money when interest rates are higher, because then they have the capacity to have a margin on a deposit as well as have a margin on the lending, a higher percentage of a margin on the lending. When interest rates come down, the capacity to keep a margin on a deposit is less, and the capacity to keep a higher margin on the lending is also less, because it means that you have competition and it's very difficult to maintain that margin. So generally you find when interest rates are on the upward tick, the ability to make returns also is more for the bank because of NII, net interest income. So, but that's a different topic. But bottom line is that the bank has to basically look at their mix of credit assets and liabilities, project, and then come up with exactly what their liquidity management strategy will be at any given point in time.
So we have seen banks giving fixed rates for longer tenors in terms of assets these days, but the rate seen in the low interest regime, do you think that is profitable to the bank in long run?
Yeah, so I think few things there. Let me put it this way. If you are a borrower, if you are a customer of the bank, right, you will come and ask the bank, look, I want to borrow money, but I want to fix my rate for 5 years. Do you think, sorry, who is this speaking?
I'm Lahiru, sir.
Lahiru. So Lahiru, you think if at current rates, would you like to fix your rates, interest rates, if you are borrowing?
Yes.
You would like to. So obviously, like you, I think a lot of people would like to fix their rates at current. And I think, if I'm not mistaken, there is a regulated 7% for housing loans as well now that the banks are supposed to give customers, right? If I'm not mistaken, that's by central bank regulations. They have sort of mandated that you have to lend on housing at 7%. Yeah, so
Yes,
either way, the bank has to give a 7%. So now the question about whether it's profitable for the bank or not. So if the bank has a view on interest rates, that interest rates will go up in the future, yeah, and then it's giving out a fixed rate of 7% based on a client requirement or a regulatory requirement, then the bank has to have a way of hedging that. Agreed?
Yes, sir.
So in other words, if I have lent at 7% for 5 years, I should be, in a very simple way, able to at least borrow at, we'll say, 6% for 5 years. Agreed?
Yes.
Yeah. So in other words, either you'll be able to take a deposit at 6% for 5 years, or it has to be able to do a interest rate swap where it will be paying fixed or rather, yeah, paying fixed for 5 years on a swap with another customer or whatever. Now, unfortunately, if you were a depositor, would you be happy to deposit 5 years, 6%?
No, sir.
No. So then interest rate swap is the other option where you can go and say, okay, look, I will go enter into interest rate swap with another bank or customer where I will pay that person 6% if they are willing to receive 6% from me and enter into a swap. So unfortunately, that also is not a product that is readily available in the local market. Agreed?
Yes, sir.
So then how does the bank manage this? So unfortunately, the bank in Sri Lanka do not have a very good way of managing. So I agree, there is a gap in the how you can manage the risk. So very few banks actually give this product, mind you, right? And when the banks do give it, they manage it by borrowing short term. So what I mean there is, if you are lending to you, if the bank lends to you, say 8 or 9% or whatever that means, right? Generally, the Treasury will be transfer pricing that to the business at around, say, if you are borrowing at 9%, you will be getting it at, say, the Treasury will be giving it to the business that's lending it to the customer at, say 8%, we'll say, for example. How the bank manages it is by basically playing the yield curve. They will fund it short term on the repo or reverse repo window at 5.5% or whatever it might be, right? On a constant basis. So you have a lending at 8% to the business and you're borrowed at 9%, and they will basically fund it on a short-term basis throughout the life of the loan. Yeah. Now, if by any chance it's a 5-year loan and for 2-3 years you do this, and suddenly interest rates start to spike higher. For the last 2 years, the bank is close to its break-even rate that it has lent at, or it has basically exceeded and it will lose money. But through the life of the loan, it might still generate income. So that is why you find that you don't find too many banks giving fixed rate loans. The banks that do give it are the ones who have like children's savings accounts and long-term deposits which are sticky, which they are paying very low interest rates for and managing. So a lot of banks will have these children's savings accounts and funding accounts on their book to build capacity, at least for 10 years, where they can then take that part of their liability book and build an asset book on the other side for the lending side of things. But I do agree there is a risk there because the market doesn't necessarily have products to hedge the long-term lending risk. I put it the other way around. You take a deposit. That's the lending side of it. You take a deposit. You remember the time that the banks were paying 20% interest rates or at least 18% for deposits? About 4 years ago, their deposit rates were about 13, 14%. About 6 or 7 years ago, I remember placing a deposit for 20% for 5 years, per annum 20%. Now, you can ask the question, why would a bank want to take deposits at 20% for 5 years? How is it going to hedge that? Do you agree it's a difficult thing to do?
Yes.
Yeah, because if you borrow at 20% for 5 years fixed, you will never get a person who's trying to borrow from you at 25% for 5 years fixed. You're running a mismatch on your book. But why did the banks do that at that time? Because banks didn't have liquidity and there was a shortage of liquidity in the market. So the most banks took the view, okay, this is a good time for me to lock in my rates, lock in my funding. Take 5-year deposits. Interest rates are high enough. People are definitely going to come and put money with me. But what happened after that? After they had put the 5-year deposit, 2-3 years later, interest rates dropped. We are now at 4%, 5%, whatever. Yeah. Now, did the banks have a loss? Of course they did, because all those deposits they took, a majority of it, they've been lending now at 5%, 6%. There is a gap. So till those deposits run out of the book, the bank's capacity of passing on any interest gain or whatever is not there. They are making negative returns. But remember, over a lifespan that reduces, but still you're running it without having a profitability on those particular deposits if interest rates come down. But it's done for liquidity purposes. And the market was conducive to raise those deposits. As it is now, the market is conducive to raise assets. But again, like Kasun mentioned, banks are not necessarily going out there and trying to sell these long-term thing. At least they're not doing it cheap. They're doing it at a cost because they realize that, look, interest rates can change fast. Sri Lanka, as fast as ever. So that's a dynamic situation. And if we have derivatives or we have a secondary capital market products that can give the banks the opportunity of going and offloading that to another institution. So for example, if I were to lend to you at 8 or 9%, if I can find a, say, insurance company who needs long-term assets on their book as well, and say, look, I have these assets that are giving me fixed at 8 or 9%. I want to structure something where you can take these assets from me, and I will give you 8% on, or rather, you pay me 7% fixed on that. Right? You structure a deal that way. And then that guy will take on the bank's risk, and then the bank sits in the middle. It becomes a structured, financing thing. But you can carve out those asset book that you have to a borrower, or like I said, you do an interest rate swap with that counterparty and basically offlay that risk. The insurance company needs long-term assets on their book, fixed assets for their portfolio. They might think it's a good time to invest in that, and they might not have the capacity of getting that yield in the market because nothing gives maybe 1 or 2% higher is what they want. but you need to be able to structure that in that case.
Are we allowed to do it in Sri Lankan banking?
Derivatives are allowed, and we've done it in the past. And the thing is that the market is not mature enough, and you don't have too many transactions going through. But yes, you are allowed to within certain regulatory boundaries. You are allowed to. Yeah. So basically, going on to the next one, liquidity versus profitability. We touched on this a little bit. So, not short run, is short run. Liquidity is more important than profitability. Do you all agree?
Yes, yes, sir.
Yes. Why is it more important than profitability? Why is liquidity more important than profitability?
Because the bank has to honor their obligations at any time. So in a short run, there should be enough liquid to honor their depositors' requirements, right? So
Yes,
otherwise, they'll
correct.
risk the bank.
So basically it comes down to creditworthiness, right? At the end of the day, if you don't have the money to give your depositors back, in a requirement that they might have, ultimately you are leaving the risk that in the future you will not get business, you will not get depositors, you will not have any way of sort of managing the your future. So in other words, it's a basic requirement of a bank that the liquidity has to be good, because it's, like I said, goes back to building principles of building blocks of a bank. It's built on trust, and trust is managed over time, and trust is based on doing what you say you're going to do. So if you say, tell somebody, give me the money, I'll give it back to you when you want, yes, then you give it back to him when he wants. Simple as that. So liquidity make sure that you can do that. Yeah, so then the next question, can we borrow any amount at some rate? If yes, liquidity is one asset. The only reason we have to stay liquid is to avoid paying higher costs. So I mean, this is coming on this point, right? So if you can borrow money from anybody at any time from a counterparty, but you have to pay a cost for it, that will then impact profitability. Agreed?
Yes, sir. Agree.
So in a forced situation where you have no liquidity, but you are pretty confident that if you go into the market, you can raise that liquidity. So you have no problem in raising it. But in that scenario, because interest rates have spiked up, or something else like that has happened, you have to pay a higher cost. It will profitability. Yeah.
So I have a question. Then when you are illiquid, that means you have a liquidity problem.
Yes.
That market perception about you or your bank is not good enough. Therefore, I think under these circumstances, the borrowing money would be a question, because counterparties will look into your profile, whether you have, what is the reason for illiquid your bank, if there is any issue with the bank or any crisis within the bank. I think in that situation, borrowing of money from the market is a question. That is my view. How about you, sir?
Yeah, I was going to touch on that next. Based on that. So basically, this part of the thing was about, there are two aspects to what you said. 100% correct. I agree with you. But there are two aspects to it. There is the overall market situation, and there is your own creditworthiness. Yeah. So if you are in a situation where the market itself is illiquid because of a market event, if you take pandemic, if you take the Easter Sunday bombings, if you take all the other things that have happened right now, for example, we had in 2008, we had the whole, you know, Selinko and all that issues, right? 2000, was it 9 or 10? I can't remember, whatever that time was, right? So in that time, it was one bank, yeah, or a few banks or a few institutions, and the whole market was impacted from it. So why is it that the whole market is impacted? Because it becomes, if the bank in concern is of systemic importance to the market concern, immediately people worry that, look, can this bank be impacted by it? Can the other bank be impacted by it? So on and so on. So in other words, everybody is watchful of the other person. So you want to be liquid. So there you might go out and say, look, I want to borrow money. So what you just said, they'll can ask the question, look, he's not impacted by this issue, but why is he borrowing money? Does he have credit lines to that bank that was impacted? If I lend to him, will I be able to get the money back from him? Because he will not be able to get the money back from the guy who's impacted. So it's not only the institution that's impacted that gets viewed at, the whole market gets viewed at in suspicion. And that suspicion leads to high interest rate. That suspicion leads to a reduction in limits at whatever rate that you can give, right? So if you are liquid and you are not impacted by this, you're fine. If you're illiquid for whatever reason, because you have a payment going out or, you know, something or the other, and you are not impacted by the market scenario, you should generally be able to borrow it, but at a higher interest rate, as long as you can convince your lender that you're still good for the credit and there are cut lines for you. Yeah. Now, in the scenario where this one, where you just mentioned, where you are directly impacted by a situation, everybody knows that you are impacted by it. Obviously, nobody's going to lend to you at whatever interest rate. And even if you are credit worthy, meaning that everybody knows on the longer run your credit is still good, yeah, you might not be able to raise short-term liquidity because people have situations where either A, they are a bit worried about your situation, so they might say, look, we don't want to lend it to you right now. Or on an overall situation, the market in totality has a lack of credit or money. They said, no, look, I need my money. I want to be with my money. I don't want to lend it to anybody. So they just want to hold their cash. So you could have a liquidity situation because of that as well. So it's a dynamic process where you have to see at any given point in time, if there is a stress in the market, overall market, can you cope with it? If there's a stress to your own balance sheet, can you cope with it? Who are the people you can go out there and borrow money from if you really need to do that? But I agree, there can come situations where you don't have any sources of funding. Then you need to go to central bank or the regulator and borrow. And that's exactly what happened in 2008 with Lehman Brothers. They ran out of liquidity. As soon as people realized that these guys were in trouble, people cut liquidity to them or limits for them and lines for them. And they couldn't raise funding they required. Obviously, then the street found out about it. They didn't want to, people didn't want them, and people were basically coming to take their money out of their place. They went back then to the Federal Reserve, and the Federal Reserve refused to bail them out, and they crashed. After that, because Lehman had limits with all the other banks who they had to lend, they had bought money from. When they crashed, it had a contagion effect on the rest of the banking system in the US. Then the Fed realized, oh my gosh, this is not going to stop here. And then they intervened to provide liquidity and restore confidence in the market. Is that clear?
Yes, sir.
So obviously liquidity is more important than profitability, that we've sort of established, but it does, raise in liquidity can impact profitability depending on how and what cost we have to bear to get that. So availability of funds is determined by, yeah, so managing liquidity is the main concern of the Treasury. I wouldn't, okay, it's one of the main concerns, let me put it that way. But the availability of funds determined by banks, means banks, credit worthiness, money supply. So that's understood. If you have a bank, if you are a bank that has demonstrated that it has always met its obligations, it has a good credit rating, and there is plenty of liquidity in the market. So first 2 points are more internal to the bank, to the institution itself. Third point is more to do with the market itself. So like we said earlier, now currently in Sri Lanka, most banks are liquid and ratings are decent. So I don't think the first 2 points are a problem. And also third point, there's plenty of money as supply in the market at the moment. So where funding is concerned, credit is concerned, there's plenty of credit in the market at the moment. Or plenty of liquidity in the market, sorry. Okay, so before going there, any questions on that section? Now, we are looking at 3 areas that basically ways that the bank could probably manage its interest rate risk, as well as its exchange risk, as well as its liquidity. First thing we are looking at is gapping. I touched on this briefly. What does gapping mean in your own words? When I say gapping, what does it mean? What's a gap?
Gap is the difference between a determined and the actual limits.
Determined and the actual limits. Okay. Another version of it? Somebody else?
It is managing maturity mismatches.
Okay, fine. Anything else? Okay, so we discussed this, right? Where you can't have a perfect match between your deposits and your liabilities from a tenor perspective. Like somebody asked about having long-term assets. How do you, and giving fixed rates for those assets, how do you manage the risk on those assets? The interest rate risk. So you have different aspects of looking at it. So you have 2 risks, right? One is the gap in terms of your assets and liabilities tenors. And then you also have a risk that based on those tenors and based on your view on interest rates, how do you manage the interest rate risk coming from those gaps? One is a risk in terms of funding, other one is risk in terms of interest rates. Is that understood?
Yes.
Yeah, so think of it this way. You have a 5-year lending and a 1-month deposits. So you have, what is the gap there you have? You have 5-year lending for 5 million and you have 1-month deposit for 5 million. What is the gap you have there?
4 years and 11 months.
4 years and 11. So every month you have to, assuming you can't get long-term liabilities, deposits, every month you have to think of rolling over that deposit every single month. Yeah.
Yep.
So that's the gap in terms of your maturity profile. Then that gap will translate into an interest rate risk. Agreed?
Yes.
Because you have a 5-year, we'll say at 10% the lending, and you have a deposit at 1 month deposit at 5%. Yeah. So every month you have to make sure, or you have to be concerned that the interest rate will stay below 10% or somewhere around there, correct?
Yes.
So you have then, because of that maturity gap and funding gap, you create a interest rate risk on your books. Now, the second point here, it says creating a gap strategy to take advantage of expected change in interest rates. So what does that mean? I already touched on it a bit. What do you mean by that? Creating a gapping strategy to take advantage of expected changes in interest rates. What does it mean? Take one step at a time. So what does it mean when you create a gapping strategy?
Hello. Hello.
Yes, go ahead.
So if the interest rates are high, we like to have less liability with the more assets.
Agreed.
So something like
Okay.
that. We are trying to do a strategy, gapping strategy.
Okay, so fine. You touched on one asset. So you have interest rates are high, so you like to have more assets, and you have less liability. So how would your gapping strategy be then? Okay, that's understood. What would your gapping strategy be then? What you've said is correct, but what is your strategy, specific strategy?
Positive, yeah.
No. Forget the positive, negative for a second. Just tell me what, in your words, what would your strategy be? You want to have more assets, less liabilities, no? Right?
Yeah.
We also know that we can't have perfect
So we like
assets.
to have short-term. We like to accept short-term deposit.
Yep.
With a long-term
assets. Okay.
Yeah, assets.
So good. Right. Then that's correct. Then that's one aspect. But what's your view on how does your view on interest rates play into this? What is your view on interest rates for that particular
increase in interest rates?
So if you are increasing interest rates, then why are you still having short-term liabilities?
So then we need to pay a lower rate of, longer term. It should be longer term.
Yeah. So basically, if you create an asset and then you have short-term liabilities and your view this interest rates is going up, then you're running the risk that those short-term liability deposits you have are going to become more costly over time, right?
Yes, will be repriced, higher cost.
That's right. So you have to always take a strategy along with a view on what your rates are. So there's nothing wrong in what you said, but you also build in your liability strategy based on your view. So instead of, if you have a 5-year asset and you want to take short-term liabilities to make use of that differential in the liability rate and the asset, you should at least see where in your asset book, on your liability book, where you can put in liabilities that are sort of can be managed, where if interest rates do go up, you still have an option of repricing it at the right time at the lowest possible rate. Or you don't take your assets out, say, to 5 years, you do your asset average up to 3 years, where you feel if interest rates start to pick up, that will get repriced at that point at the higher interest rate. Does that make sense?
Yes, sir. Then other way around, that means it's better to have a liability mix in different time horizons.
It's always good to have a diversified liability book. It's always good to have a diversified asset book, both sides. But your diversification means also, remember this, diversification is good and bad. Diversification means that if you have 50% or 50% of everything, then ultimately, your ability to profit is less. So your diversification should be diversified, yes, but you have to be able to skew it towards the area that your view is. So for example, if your view is that interest rates are going to be lower for longer, and then you have a 5-year asset that you put on your book, and then you put a 3-year liability and pay almost the same rate that you're paying for asset, you're not going to generate as much income, right? So if your view is that no, interest rates are going to be low for at least 3 or 4 years, then you might as well borrow 3 months and 1 month and run that position. So you need to diversify, and then yes, you take a few 2-year deposits, you take a few. So you need to be able to make sure that you have a risk diversification, but to the extent at which it doesn't take away the opportunity of you generating income. Make sense or not?
Yes.
Okay, so there are 2 types of gaps, negative and positive. So negative gaps are created when we fund long-term assets with short-term liabilities, what we've been discussing all this time. So what it means is that you've created an asset and you have a liability which is short-term. So in this case, asset at 30%, and you have a 6-month liability at 25%. So you have a negative gap. Negative why? Because at any given time from a tenor perspective, you are short on the tenor. So you're negative on the tenor. Doesn't matter on the interest rate. It could be that you raise that liability at 35% even, if you need it for funding purposes. More to do with the period. Questions? Okay. So from a view perspective, now we're talking about the interest rates, right? In a negative cap scenario, if you're basing it based on your view on interest rates, you are expecting one of 2 things. Number one, you're expecting, in this case, interest rates to remain at 25%, or number 2, you're expecting interest rates to come down below this. So you're creating an asset at a higher rate, and you're expecting the rates to come down further after 6 months is over, or at least stay at the same level. So from a compounding perspective, you still be generating a decent income. Now, my question here is, in reality, what's the difficulty here? In reality, what's the difficulty here?
The liabilities are always on demand.
The liabilities are always not, sorry, I didn't get you.
On demand, sir. On demand.
On
Yeah,
demand,
yeah.
that's right. Yeah, and the other risk is that, I mean, at higher
We
interest
can't
rates,
expect that that liabilities. So that means the deposit will come on time to that particular period.
yeah. So even if the deposit is not there, if you have to make sure what? If the deposit is not there, what is your job? What do you have to ensure? What did we discuss earlier? That you have What? That you have alternative sources of funding, right? So even if the deposit does not come to you in 6 months' time, or if it goes away, you should be able to, in a normal situation, go out into the market, borrow interbank funds, raise a corporate debt, borrow from another depositor, whatever it takes to plug in the gap. That's your job, to provide the funding, to balance the books. That's the Treasury's function ultimately. Now, while doing that, it has to monetize its views. So, for example, if the business line has created an asset for 30% and then a liability for 25%, Treasury will buy that liability into their books at, say, 26% and lend that asset to the other business at 29%, right? Now, in 6 months' time, if that asset is no longer there, and the business, the liability generating area, some says, look, we don't have deposits to give you, you have still made a commitment to lend to the lending business at 29%, right? You need to go out there and be able to fund that 29% at interbank rates and provide it at the transfer pricing agreed to the business. One is the funding aspect, other one is because you have said 29%, and from below that Treasury will have to generate income. You have to be able to borrow at 27%, 28%, 26%, whatever it might be. So it's up to Treasury to make sure those funding sources are there and to optimize profit by making sure that it's less than the rate that had been agreed at with the business line or whatever the transfer pricing rate is. The risk also here is that whether or not you can raise assets at 30% or not for 1 year. And then obviously the other risk is that interest rates will go up instead of come down. And then if it goes up, obviously the bank is going to lose money in the process. Bank, when I say, Treasury is going to lose money because ideally the business has already locked in and managed this risk through the Treasury Department. Is that clear?
Yes, sir.
Yeah, so what we discussed, the risks are price risk, rates going up. In this case, it shows that you're raising the 6-month deposit at 40% or 6 months funding for the naming is at 40%. And the other one is unable to get funds at all. So in other words, that's where the things get nasty, where the market has gone against you, people don't want to lend to you, or there is a problem in the whole market itself and there is no money. So price risk as well as liquidity risk, as I said. Yeah. Any questions on that before we go to the positive gap part of it?
Sir, could you explain again what is negative gap is?
Sure. So I'll take you back to, you understand what a gapping strategy is?
Yes, sir.
Okay, so what is a gapping strategy in your view?
It is to take the advantage of interest rates fluctuations.
Yes. More, okay, interest rates. And the other reason for having a gapping, what's a gap?
Gap is a difference between maturity dates of liabilities and assets.
Yes. So, like you said, I'm sorry, I didn't get the lady's name.
Anuradha. I'm Anuradha.
So Anuradha, the gap, like this gentleman mentioned, the gap is where the bank will create assets, basically loans, and the bank will create liabilities, but the maturities of those assets and liabilities won't be equal. So you might take a 5-year deposit, 3-month loan and lend money for 5 years. There will be a mismatch in the maturities. Understood?
Yes. Yes, sir.
Yeah. So there is two things. One is the mismatch in the maturities. Other one is because you're taking them at different interest rates, where you're lending at hopefully a higher rate than what you're borrowing deposits at. There is always a risk that the interest rates will go against you, where your long-term rates, interest rates will go up or down depending on what kind of gap you have, and that will cause a loss to the bank. Yeah. Understood?
Yes, sir.
Okay.
Understood.
So banks will create a gap as a strategy based on their view on its interest rates. So in other words, what we discussed now was a negative gap. There are two types of gaps. There are negative gaps and positive gaps. Negative gap is where the bank will give more loans out for longer tenors. So in this case, it has given a 1-year loan at 30%, right? And it will take deposits for short term. Now, why would the bank create a negative gap? Why would it give a loan at 30% and take deposits only for 6 months?
To take advantage of the interest rate fluctuation.
Take advantage of the interest rate, lower interest rate, and also something else. Take advantage of lower interest rates in the short term. And what's the other reason? Anuradha, you tell me. The bank will give a loan for 1 year at 30% and take a deposit for 6 months in order to take advantage of the what? Or rather, hello? 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 Is anybody else there?
Yes, sir.
Okay, sorry, I think she must have lost the connection. So basically, I hope she can hear me. Basically, the bank will create a long-term asset and have a short-term liability to do two things. One is to take advantage of the current lower rate for short-term liabilities. And also, if it has the view that interest rates are coming down in the future, it all going to be at these current levels for a longer time, it will continue, it will basically take a liability that's short term. So that way, if interest rates come down to 20%, as in this example, the bank will generate more income because its view also was correct. If interest rates go up to 40%, it will lose money and the view is wrong. So
Yes.
that is something that needs to be actively managed. So the only reason the bank creates a negative gap is A, because it has a view on rates and it wants to monetize the interest rate thing, and B, because it can generate interest rates now at a cheaper rate than where it can generate deposits now at a cheaper rate and where it can generate assets at a higher rate. Now, there is a situation where, right, there is no choice. So, for example, like I mentioned, I think it was Ruchir or Kasun who spoke that time, where they mentioned where banks are giving deposit lending now at 7, 8 or 9% or whatever for long-term assets. And how are they going to hedge the risk? Now, either the bank has a view on interest rates like this and is creating that kind of negative gap on their books purposely, or sometimes they don't have a choice. They're doing it and they're managing the risk on a short-term basis because there is no other way to raise liabilities for that kind of period. And in that sense, they're managing the liabilities on a short-term basis, maybe 6 months, maybe overnight, maybe maybe on a 1-year basis, I don't know, in a liability in a way so that they can manage the risk that they put on the book. Because ultimately, if you are flush with liquidity, you need to create assets, you need to generate revenue for your shareholder, return for your shareholder. And if the market is saying, look, I need long-term assets, give me something where I can pay you fixed, then you need to look at that. And you need to build in a pricing for that, basically. So the other part of the thing is liquidity risk is that you not risk negative gap is that you will not get funding at all. So one is the price risk, other one is the fact that you will not get pricing at all, meaning funding at all. So whatever you are willing to pay, even if you are willing to pay 50%, 60%, then there will not be money in the market for you to raise funds if there's a negative gap. That's not about profitability, more to do with pure and simple funding yourself. That clear?
Yes, sorry, I got disconnected on the when you are explaining. So I joined again. I got got your point. Thank you.
So no problem. So if the basic thing to understand is that the gap is a gap in maturity tenors, and then how you position yourself with that. So a negative gap involves both a price risk and a liquidity risk because your prices can change and your funding requirements can change. So let's jump into the positive gap. Opposite of negative, as you can imagine, you create more liabilities, tenor-wise, create more liabilities tenor-wise, and then you create short-term assets. So if I were a bank now, if I had the choice of doing something as a bank now, and people will do whatever I tell them to do, what would I want in this current interest rate scenario? If you are a bank guy and you can decide and tell your customers, and the customers will do exactly what they tell you, what you tell them to do, what will you tell your customers now? Not in the customer, I mean, you have to always think in the customer's interest, but I'm thinking from your side, what is the ideal solution for you in the current market?
Encouraging to get encouraging for lending rather than the deposit side.
On the bank's point of view, huh?
Yes,
so you're saying encouraging lending, yeah, okay. Okay, anybody else?
So we are motivating them for a term deposit.
For how long?
Longer period.
Longer period, okay. Anybody else?
Increase the liability mix with short-term loans to bring down the NII. Increase
Okay,
the
let me put this. Okay, let me put it another way. What is your view on interest rates? Repeat interest rates.
Increase.
It will remain for
Increase.
a
In how long? What period? 1 year, 2 years, 6 months, 3 months, 3, 4 years? What period?
At least after 2 years.
After 2 years, okay. Anybody else has a different view? There's no right or wrong. I mean, I don't think anybody has their one view is right, so that's fine. What are the other views?
I think the low interest rate will remain sometime
For how long?
3-4 years.
3-4 years, okay, fair enough. Anybody else? Okay, so we'll take one at a time. So if for the view of low interest rates staying there for 3-4 years, then what kind of position would you create for yourself?
So we have to lend short term and take deposits, and that means liabilities, long term deposits for liabilities.
So you will basically, if you believe short interest rates are going to remain low for a long time, I would basically look at taking short-term liabilities like 1 month, 3 months, because remember we have a positive sloping yield curve. So you don't want to pay up the curve. You can continue to, if you believe interest rates are going to be low, borrow short-term at lower interest rates. Agree?
So can't we borrow at long term, sir? Not very long
So,
term.
okay, so let me put it this way. If you're paying 3% or 4% for a 3 month, and if you want to borrow long term, you have to pay 6% or 7%. You agree on that? Because the yield curve is upward sloping in Sri Lanka. We have an interest rate curve. Have you all done yield curves?
Yes.
You know, if you plot a yield curve and say that your 3 months is 4%, 6 months is 5%, and 1 year is 7%. Yeah. What would, if you believe interest rates are not going to go up, where would you like to borrow yet?
Short term.
Short term, 4%. So you will have.
Yeah, I have some idea.
Sorry. Sorry, I can't hear you. Please repeat. I didn't hear you. Hello.
Sambat, probably there's an issue with your mic.
Yeah, so just to be clear, if your view is that interest rates are not going to pick up for the next 3-4 years, you will borrow short-term liabilities, and then you will short-term liability as short as possible. As long as you don't, as long as you don't have a funding problem. Remember that. As long as you're comfortable with your funding situation, you will borrow as short a term as possible.
Short term is profitable.
It's profitable, but remember you have to always mix it with your funding position. As in your ability to borrow money every month or every 3 months or whatever. Yeah. Then, yeah. And you will then create long-term assets. You will have a negative gap. Because your view is that interest rates are not going to go up, right? So you will like to create an asset on your book that's longer term at the high end of the yield curve, at the long end of the yield curve, correct?
Yes.
Yeah. So you will run a negative gap there. Yeah. If your view is that somebody said interest rates are going up fast or soon or something like that, or in the next year, then what would you do?
Then you have to convert the liabilities into long term.
Yeah, forget about the converting. Say you're starting from scratch. Your view is that interest rates are going up soon. How would you position your balance sheet now?
Borrow long term and
go for a long term.
Borrow long term and
invest short term.
Invest short term. Because you want to reprice at a higher rate for your assets, and you want to delay your repricing on your liabilities as long as possible. Correct?
Yes.
Yeah. So then you create a positive gap, meaning why positive gap? Because your funding is positive, because your tenor on the asset is shorter than your liabilities. So in the other one, it was negative because your funding was negative, because the tenor was longer on your asset than your liabilities. In this one, it's called positive because you have money. Your view, your ability, your positioning it mostly to do with interest rates. Yeah. Agreed? Not agreed? Questions? Feedback? Anything? Okay. So outside of the interest rate view that you have on this, okay, if your interest rate view is right, and like it says here, it goes from 30 to 40%, your deposit is fixed at 25, and then you have a higher return on the second leg of your deposit. Yeah. So you have a price risk if interest rates come down. 30% 6 months, next 6 months on your deposit lending, you can only get 20%. So your view is wrong and you can lose money. There is one more risk here, right? Which is what? You have a positive gap, so you have funding. You have the asset created for 3 months. You understand the price risk. There's one more risk which is very remote but can happen. What is that?
Reduction of interest rate on assets.
Sorry?
Sorry, reduction of interest rate in between that within the 1 year's period, sir.
But then that's already covered, you know. After 6 months, say this is fixed. This guy will not, he won't change. This will reduce here, and then you'll have that issue. The risk I'm talking about is that, look, this is broken up into two. You have money here for the 6 months. If you don't get somebody to borrow from you, and you are forced to put this money into central bank or another source of guy who borrows from you at a very nominal interest rate, then you have excess funds that you can't deploy. As much as the other one you didn't have funding, they have too much funding. Often you can always lend to central bank and you'll get some return on it, right? But if you're reducing and you reduce your assets, and okay, instead of giving 30, same customer now has to borrow at 20 because market interest rates have come down. That's simply the market. But if you don't have borrowers and the borrower says, look, I don't want to borrow from you anymore, I have enough of funding sources from elsewhere, what are you going to do? You're going to go and lend to central bank as a borrower of last resort, or as a way of just parking your money, or it just sits there in your reserves. Then you have the risk that you don't get the return at all. Now I'll give you an example of this again. Say, like I said, in 2008, when the banks were flush with liabilities, the good banks that what came out of all the situation were flush with liabilities, most of them had to go and park their money at the Federal Reserve, which was at 0%, right? So they may have lent earlier whatever money they had that, whatever to lenders at whatever 1%, 2%, whatever the rate was. But later on, by choice, even though interest rates had come down, and there was a loss on the price side as well, they had to also make a choice as to who they can lend to. And because it was a risk element, they had to go and lend it to the Fed at 0% or central bank at nothing, basically. And it was both a price risk as well as a risk because of the counterpart trust, and the fact that you want to keep liquidity in the market. You don't want to have risky assets on your book. Clear? Okay, so summarizing it, we have negative gaps, we have positive gaps. So in a negative gap scenario, where you are expecting interest rates to come down, what would you do? You will create long-term assets. Your expectation, like I said, is for interest rates to be less or equal to the current market rates, and your risks are price and liquidity. Positive gap, you have your view is that interest rates will be higher in the future or equal to current market rates. So you create short-term assets and you fund it with long-term liabilities. Main risk here is price, because that's the main one, but there is a risk, like I said, that you will not be able to deploy your excess funds to an asset that you want. Ultimately, it will all come down to price. But, so that's why we've said the main risk is price. Now, the question I have here is what the practical aspect of this is. Meaning, you have these gapping strategies and stuff like that, and you have a view on interest rates. So, for example, right now, if we were taking the view that we want to do a negative gap because somebody said interest rates should pick up in the future, and therefore, you want to create a positive gap because you feel that interest rates will pick up in the future. This one, yeah. Now, how do you think it's? How do you do this? Is it easy to go and create short-term assets and get long-term liabilities? Practically speaking. Is it easy to get short-term assets and long-term liabilities?
Not practical, sir.
Not practical. Why isn't it?
Even that depositors also has an idea that interest rate will move in future with the market sources, and then they also more vigilant about the deposit rates. Therefore, they do not invest in long term.
Exactly. So practically, managing this kind of risk is not as easy as it sounds. Yeah. Same way with the long-term, if you negative gap. If you believe that interest rates are going to come down in the future, right? Convincing somebody to take a loan at 20%, if 20% were the rates, or 10% if the rates were there, and then saying, okay, I'll give you a 10% loan because you have the view that loan rates will be lower. People don't want to borrow double digits. When interest rates are 15%, and we said, look, you want to go 10, we can give you a loan 15, we can give you a loan 15%. We said, look, if I have to take 15% loan for 5 years fixed, where am I going to make a return on my business? Half the money, most of the money will go for me to fund my interest cost. So it's not practical. While at the same time, right now, people will be very happy to borrow long term at these current rates, as long as the rates are attractive, like 6%, 7%, 8%, whatever, be very attractive. But that's not the ideal situation for the bank if the bank's view is that interest rates are going to go up. If the bank's view is that interest rates are going to stay low, like somebody mentioned today, then that's fine. It's perfectly fine. Then what they do is basically they will go out, create a negative gap on their books, give long-term assets, right? and keep borrowing short term. So it's very rare that that whole thing matches. But what you have to be careful about is when you are managing a situation like this, you need to make sure that your view on interest rates is very clear. Now, remember, view is a view. It can be right, it can be wrong. You can have a contrarian view to the rest of the market. You can have the same view as the market, but you have to have a view, especially when you're sitting in a treasury function. You have to have a view. You can't not have a view, and you have to have an opinion about things, because and it has to be not just for the sake of having an opinion and view. You have to have a do your research analysis, figure things out, and say, okay, this is the way I think things should be. Because, like I mentioned earlier, function of a treasury department is internal as well as external. You are the closest point to the external environment. You understand what's happening with the economy. You understand what's happening with the interest rates. So you have a very good gauge of, how things are basically. So in that context, I think it's important to have a view and be able to monetize that view in terms of a strategy you're putting into place. And this is exactly what you're doing here. Any questions? Any questions? Right. No questions. Okay, so let's see now. Let's stop there for today. I will take a few questions, and we'll finish the bit on net open positions and on the capital hedging side next week. But we'll just take a few questions now, and then we'll stop it there, because I think we did 3 sessions today on 2 sessions on gapping and liquidity. I think that's enough for today. And we'll touch on the net open position next week when we meet next week. Yeah. Question number 1. In order to stay liquid, we have to sacrifice part of our, what do you think?
Yield.
Anybody else? Yep, correct. Managing liquidity on the liability side means determining technical reserves, complying with legal reserves, establishing accessibility to new sources of funds, giving up profitability. On the liability side, huh?
Establishing accessibility to new sources.
Okay, so we have somebody saying D, somebody saying C. Anybody else?
C.
C, okay. Anybody else? DC. So basically, what it means is that what I mentioned, if you have a depositors or set of depositors who are maturing, and then suddenly you need to find funding, and those depositors don't want to reinvest their money, then you have to go out and find alternate source of funds. So part of managed liquidity is being able to fund that excess or the shortfall as and when the need arises. So you need to have new sources of funding.
Sorry, I don't know whether you have explained it. What does it mean, technical reserves?
So that's operational reserves, basically.
Okay, right, thank you.
Same thing as legal is what we discussed earlier. Which one of the following statements is true? We can always get money if we are willing to pay the costs. Sometimes we can't get money at any cost. The more liquid an asset is, the more it yields. The only reason we have to stay liquid is to avoid paying high rates. Which one is true?
I think B.
B. Okay. Anybody else? Anybody else? Correct. So what we learned was that, look, you can, in a stress scenario, either to the market or to yourself individually, even if you are willing to pay high interest rates, you can't, get money. So classic examples of this are, if you look at, in our case, Sri Lanka's case, like the Golden Key, they were paying 30% interest rates at one time, and market interest rates were about 20%. Now, at that time, that was before the whole, collapse happened. But even in that case, people should have asked the question, why do they have to get that kind or give that kind of interest rate to generate a deposit? Why can't they generate that money without paying that interest rate? So there's questions should have been asked. So there's always a red flag if somebody is paying you high interest rates to get money. At some point in time, people figure that out, and then they stop giving funds to that institution. So that's why a lot of banks, even if they have a liquidity issue, and it's very short term, they are a bit concerned about going out there and raising that liquidity at a higher cost. They would prefer to manage it as much as possible without having to pay a high interest rate, because it gives a wrong signal and it could dry up the rest of the risk on fund resources they have. Yeah, this is what I just mentioned to you. Which is the answer?
It's D.
Which one? B or D you said?
D.
D. Okay. Anybody else?
D.
D. Okay. See, if it's very short term and there is a short term requirement. So, for example, if you have created a liability on your book where you need to raise money, banks can go out and pay a higher than another bank. Otherwise, for example, somebody's paying 6%, another person paying 6.5% or 7%. Fine. Now we take the dollar interest rate scenario in Sri Lanka right now. If you go to a foreign bank, they'll be paying you 1%, maybe 1.5%. If you go to a local bank, they'll be paying you 5%, 6% per dollars. Now, why is that? Because the local banks need funding. They don't have credit lines from their overseas branches for this. So they need to fund it from the local market, and they need to pay a premium for that. Okay? Now, if suddenly the bank from 5% starts paying 10%, while all the other local banks are paying 5%, will that be an issue? Concern?
That could signal that the specific bank is in need of
funding, right? Dollar funding. So there is always, you have to be, banks when they're raising deposit rates, even for short-term requirements, they have to be mindful of what the rest of the market is paying and how much more they should be paying for it. Obviously, there are banks, well-established banks, who for short-term requirements. I mean, like I said, I was at HSBC, and at one time we paid 20% for 5-year deposits. Rest of the market, I think, were paying about 18, 19, 17, 18, 19%, whatever, right? So ours was the highest rate at that time, but it was because there was a specific requirement and they had to raise liabilities. So it doesn't always mean the case, but when you see a way of market rate from the rest of the market, it should always draw suspicions. If a short money supply is a problem in our country, we may not be able to buy funds at any rate. We can ask our customers to wait for their money. We can always buy funds. Buy meaning raise funds. At a higher rate, funds will be available at low rates. Which one? F5, raise funds. Basically, there's a shortage of money in the market, right? What does it mean?
Is it C?
C.
Okay, anybody else? Yeah, let's see. Yeah, why is it A? When you say short money supply, in this case, it's meaning that you have a shortage of liquidity in the market. When there's a shortage of liquidity, it means that a few people have the funds. So, for example, if you take 26 banks in Sri Lanka, and there is a shortage of liquidity because money in circulation is less, there could be a few banks who have the funds. So we'll say four banks have the majority of the money. Now, those 4 banks obviously also want to deploy the money in the best possible form in terms of return and risk. They might want to lend it to the bank that's paying them the higher interest rate and where they have the less amount of risk lending to. That's one. Second thing is they might also want to lend to you because you are a good bank who has limits, who's giving them a good return, and you have no problem. They have no problem with your risk. But there could be a situation where the limits for you are exhausted. They've already lent to you quite a bit of money. So the guys who have the liquidity may not be able to lend to you at all, and you may not be able to borrow from them at all. So if you are in that situation, or it could be that you're in trouble in a worst case scenario, and because there's a shortage of money supply in the market, you are not the topmost person they will want to lend money to because your credit rating is not the best. So you may not be able to raise funds at any rate. Even if you say, look, I'll give you 30% when the market is 20, people might not want to give it to you because your credit worthiness has gone down. Yeah, especially in a short money supply situation. If for any chance you can't get money and you're stuck like that, then you have to go to central bank and take it as the lender of last resort from the central bank. Which of the following is an example of a negative gap? Make a loan for 1 year at 15% and fund it with 6-month deposit. Make a loan for 6 months at 25% and fund it with a 1-year deposit at 20 pesos. Yeah. Make a loan for 6 months at 25%, fund it with a 1-year deposit 30%. Make a loan for 1 year and don't fund it at all. Which is a negative gap?
A.
Yeah, I think I've highlighted it already there. Okay. Okay. A negative gap is a bet that future short-term market rates will be equal to or higher than current market expectations. Match current market expectations, be equal to or lower than current market expectations, be higher than or lower than current market expectations. Sorry? Sorry, I didn't get you. C, D? C.
Equal or lower than.
Okay. Correct. We have granted a loan for 1 year at 30%. We can fund it for 6 months at 25%. But at the end of 6 months, we do not get another deposit. What is our worst problem? Worst problem, huh?
Liquidity?
Correct, because there we have a funding issue. And more than profitability, we run the liquidity risk in terms of a negative gap. So, yes. Which of the following is a positive gap? Make a loan for 1 year at 12% and fund it with a 6-month deposit at 8. Make a loan for 6 months at 10 and fund it with a 1 deposit at 6. Make a loan for 1 year at 30 and fund it with a 6-month deposit at 25. And make a loan for 6 months at 10 and fund it with a 6-month deposit at 8. What is the positive gap?
B?
B. Okay. Anybody else? Correct. So you raise short-term assets and you try and raise long-term liabilities. Oh, sorry. When we create a positive gap, I've already outlined that. We assume a price risk. No liquidity risk, just a price risk. Okay. Gapping strategies work best if we match them to our policy and match our policy to market condition, are consistent in our choice of negative or positive gapping strategies, forget about trying to make profit, focus only on the important issue of liquidity. How does it work best?
B.
B. Anybody else?
A.
A. Okay. Sorry. It's A. Because if you look at it, what did I mention earlier? You have to basically have a strategy based on your view. So generally, if your view is based on your policy, so for example, you have a view interest rates are going up, this is it. Your policy is that, look, if interest rates are going up, we'll do these things. So the market conditions are the view. Based on the market conditions, you say, okay, this is our view and this is our policy on it. Yeah. So if your gapping strategy can be matched to your view and to your internal policies, it will work well. If it can't be matched to that, then your infrastructure and systems around you don't support it. So you have to manage. So for example, if you're a very leasing-oriented bank, if you are a more deposit-driven bank, it depends what you are. And then based on that, and your view on rates and your funding requirements, all that, then you have to match your capital strategy according to that. You can't, just because your view is one thing, if your internal situation doesn't match it, you can't monetize it. Okay. That's it for this. I'll stop there. Any questions? Next week we'll start on the currency and the capital hedging, and then we'll jump into the next set of slides as well. Any questions from you? Before I knock off.
So this is out of the today's subject. We observed certain banks didn't quote rates for their outward remittances, exchange rates. Can you explain the situation?
I have not been working for the last. I'm only going back to work on Monday. I'll tell you next week.
Thank you, sir.
No. I'm just kidding. So I'll be going back. I'll be taking over as treasurer of Nations Trust Bank for Monday. This time I've been in between work, so I'll be starting there on Monday. But from what I've heard, it's because they've not been able. The banks' net open positions have been reduced. Most of the banks, if not all the banks, and in order to give your importers dollars, you have to be able to source those dollars from somewhere, either from your exporters or from the interbank, from another bank, or from central bank if they are willing to sell. So I think the sources of dollars has dried up to an extent. So when the bank runs a net open position, they can only maintain a X amount of positive dollars, and that amount has been reduced. So if the bank is now selling dollars, it's running a negative dollar position right now. Or the bank will say, look, I can't run a negative dollar position because if the rupee depreciates by me doing that, I lose money if I do that, right? But at the same time, if I can find a source of funding, then I can actually manage to give my importers dollars. If the bank cannot find a source of dollars, they can't give dollars to their importers. And this is foreign exchange we're talking about, not Nostro dollars. So where the importer will give you dollars and rupees and take dollars from you, same way you have to be able to take those rupees and give dollars to your buy those dollars back in the market, basically. So if there is no inflow, it's tough to give outflow. So the inflows come from what I mentioned, other interbank counterparties, exports, or from the central bank reserves if they are willing to sell it.
At the same time, I think.
So exporters, I think. Sorry, go ahead.
Yes, sir. At the same time, I think CBSL mentioned that you can't quote over 200 rupees per dollar.
Yeah, I've heard that. Like I said, I don't know because I've not been in the market, so I'm not part of those conversations. But there was some talk about that also, but I don't know how accurate that is, very honestly. And that is also a kind of regulation, but there is nothing formally put out there. But either way, the bank takes the risk there, because if we has to buy dollars at 205 and only sell to customers at 200, then obviously there is a loss there for the bank doing that, even if they can buy.
And
I'll give you more information next week if I can.
Yes,
so
I think, sir, that is also for that with the reduction of foreign exchange rate against the US dollar, then I think central bank wants to stop the prepayments, because customers, they prefer to do prepayments with the exchange rate reduction that during past that 194 level it was there.
Yeah.
Yes.
Yeah. Ultimately, it's in and out. It's supply and demand. If there's more demand than supply, ultimately this is going to happen. I have a different theory around this also, so we'll discuss it in detail later. But hopefully things will settle down. Yeah, next week.
Okay. Thank you.
So, from next week we have to start from slide number 20.
We'll start from net exchange exposure. Yeah.
Okay, so thanks.
Right. Okay. Thank you very much. Have a good evening, afternoon, I'll see you all next week. Yeah.